Hello, my name is Dr. Paul Cottrell, and I'm going to be going over the updates for the financial markets. I'm recording this on 8/9/2026, and I will also go over a video clip about AI. But before we do, please help support the work that I do by going to my website, the-studio-reykjavik.com, and you can donate. You can donate through Stripe, PayPal, or buy me a coffee. All these videos are for free. I also have broadcasts, audio, and live video. In addition, I have classes that you can sign up dealing with pulmonology or immunology. Those classes you can purchase under store classes. They're $25. You get a lot of videos and a lot of PDFs about pulmonology or immunology. And you can learn these subject matters at your own pace. Also, under the store, you can purchase my ebooks. I have ebooks on finance, genomics, artificial intelligence, endocrinology, and I also have supplements. So let me go over some of these supplements and how they can help your health, and then we'll go over the updates in the market. Structural nanosilver toothpaste will whiten your teeth, freshen your breath, and help bring down inflammation at the gum line. Max 35 or cleanse will help to boost up your innate immune system. Take a teaspoon a day, swish in your mouth, gargle and swallow it. I've been doing that protocol for over 6 years. The structural nanosilver gels, I have it in the tube form and the quick dispenser form called Renew. They will help speed the healing of a wound. You can use this as a topical, daily topical for your skin. And it's perfect to put on your hands and lightly coat your nostrils for the cold season and the allergy season. Structural nanosilver lozenges, I have it in Manuka honey and orange splash, fortified with vitamin C. And these lozenges are perfect for the cold season, the allergy season, or even just cleaning around the house to protect that oral pharynx. This probiotic is a veggie cap version of the probiotics that I have. And a good probiotic will help your digestion, improve your immune system, help with your skin health, and also brain function. C60 is a very potent antioxidant. You can get it in a 2-ounce, a 4-ounce, or an 8-ounce configuration. It is cheaper per ounce to purchase the higher ounce configuration. You can get it in extra virgin olive oil, avocado oil, and MCT coconut oil. C60, you take a teaspoon a day every day. It'll soak up free radicals and boost up the health of your mitochondria so you have more energy, more ATP. In addition, your tissues will have less inflammation and less stress, and therefore function better. In addition, C60 can help with your brain function by improving the health of your neurons and help with your cardiovascular system by reducing the concentrations of oxidized LDL. When you reduce the concentrations of oxidized LDL, you're reducing plaque formation. Vitamin D3 helps with your bones. Vitamin D3 also helps with your cardiovascular system and your immune system. Vitamin C and magnesium helps with your immune system, brain function, and skin. Omega-3 helps with your cardiovascular system by bringing down inflammation and helping your lipid profile. Ashwagandha root controls your cortisol levels and your blood glucose levels. Goodnight formula has tryptophan, melatonin, GABA, and passion flower that allows you to get into 3 to 5 cycles of REM sleep and deep sleep. When you get those cycles of REM sleep and deep sleep, you're consolidating memory, detoxifying your central nervous system, and you'll be well rested. And this is a great way to slow down the aging process. This probiotic is a powdered version of the probiotics. So you can take either this probiotic or the veggie cap one on the other screen. Resveratrol helps with your basal layer for your skin. It stacks really well with the C60 to help the skin. In addition, it helps with youthful gene expression, helps to get rid of senescent cells, and soaks up free radicals and boosts up the health of the mitochondria. Vitamin B complex helps with the mitochondria, boost up that ATP level through the electron transport chain. It revs up your cellular metabolism and protects your neurons through vitamin B12. Turmeric brings down inflammation and soaks up free radicals. Magnesium and zinc boosts up the immune system and your brain function. Lignans helps with the immune system and endocrine system, soaks up free radicals and brings down inflammation. Collagen helps with the skin, the nails, the hair, your musculature, bone density, and joint health. Digestive enzyme complex helps you to break up carbohydrates, proteins, and lipids and reduces the load on your pancreas. Clarity factor is a great neurostat to help improve your brain function. It gets rid of brain fog and over time improves your dendritic connections so you're thinking faster and have better memory. You'll be able to concentrate on tasks. Olive leaf extract is dual purpose. It helps with the immune system and the cardiovascular system. Zeolite will help to detoxify your body, get rid of heavy metals, toxins, and chemicals. Take 3 small drops underneath your tongue and drink filtered water daily. Myotrol helps to build muscle and maintain that muscle. It has polyphenols, flavonoids, and lignans to help with the gene expression to build muscle. Boomer Boost has 68 nutrients. This you can use as your multivitamin. It has the minerals and the vitamins that you need in addition to other supplements to help slow down the aging process. It's dual purpose. It's going to help with your brain function, your cardiovascular health, rev up your metabolism, slow down aging, improve your immune system and your endocrine system. Gladiator barley or heirloom barley will help to detoxify your body, bring down inflammation, and soak up free radicals, so superoxide dismutase. There's one added benefit with gladiator barley, and that is they'll help to build muscle. You can stack gladiator barley with myotrol. You can also stack gladiator barley or heirloom barley with Boomer Boost to help control your A1C levels. Collagen is a great supplement that helps to rebuild your collagen and your joints. If you have arthritis or a sports injury, take collagen. Now, collagen helps to reduce the joint erosion by blocking MMP3 and MMP13. It reduces inflammation by blocking EP4. It helps to recruit collagen type 2 to remodel the cartilage. ACAN to help to remodel the cushioning of the joint. It also blocks the pain channel gatekeeper NAV 1.7 to help reduce the pain. And collagen helps to recruit glucosamine to remodel the cartilage and chondroitin to cushion the joint. I also have Super Strong Relief. This is a topical that will help with muscle ache, bruising, sprains, tension headaches, even arthritis. It helps within about 90 seconds. It's a great temporary relief for pain, especially for arthritis. I also have ubiquinol, which is a very high quality CoQ10. I also have NAD plus that will help to boost up your energy levels. And nattokinase, and that will help with your cardiovascular health. I also have anti-aging boxes and longevity boxes. They're curated to help you start on your anti-aging journey. For example, the anti-aging advanced box has Health Max 35, C60, D3, vitamin C and magnesium toothpaste, and the probiotic. So take a look at those boxes, or you can purchase them separately. And again, you can purchase the classes in pulmonology or immunology for only $25. So with that said, please go to my store, get the great products that I offer. They are very high quality, and these are products that I use every day. So please go to my store, the-studio-reykjavik.com, and use discount 5 and you get $5 off. With that said, we're going to go to the charts and talk about the market. All right, this chart is the ETF for the S&P 500. It's called SPY. And we did have to update the FID sequence, the retracement lines, because we had an all-time high throughout the week, and that was at 776.85. We have a resistance level at 780. We have a very strong support level at 707 now. So your support levels are going to be at 720, approximately 700, a little bit higher than 700, about 707. And then we also have another strong support level at 663. Now, if we get positive news out of the Strait of Hormuz, we probably will be testing the 780 this week and surpass it. I'm a little concerned about this being a little too hot for the market. Now, one positive thing about the market is there was a gap up at the 760 mark. So this may have some legs. Another example is a gap up and then it really climbed. Another gap up here, climbed. Another gap up here, climbed. But you had a gap up and then it fell down here. But usually when you have a gap up, it climbs. So there's a higher probability that this is going to break the 780. I'm still concerned if you haven't already, you probably want to put about 5 to 10% in cash or cash equivalents and 90% in the broad index. That way you're benefiting from if it continues to go up, but if it does correct and goes back down to 740 or 720, 700, or even 660, you have some cash on hand to be able to buy in and get better dollar cost averaging. I still have a target of 780 for SPY and 7,800 for the S&P 500. And so we could go to 8,000 and come back down. I'm just a little concerned that 780 to 800 for SPY is a little too hot, especially in the context of the war, tariffs, and the AI bubble. This is the contract for WTI futures. You can see here that recently throughout July, prices have been going down. They have been doing a trading range for the bulk of July in between the 50% retracement and the 61.8% retracement, between roughly $80 to $87 a barrel. You can see this trading range. But it did break that support level, approximately 80. Actually, the support level is 79.62. It broke that support level and has been doing trading in a range in between 68.78 and 79.62. You can you notice here that the last three candles, the last 3 days, of trading have been inching upward towards $80 a barrel. If we have negative news from the Middle East, I suspect that we'll break the 80 and start trading back at about $82 a barrel. If we have positive news and things are moving in the right direction, we will be trading at about $72 to $75 a barrel. So it really depends on which trading. If positive news, we're going to be trading between 68.78 and 79.62. Negative news from the Strait of Hormuz, we're going to be trading at between 79.62 to about 87.23. What surprises me is we haven't received much news this weekend about the Strait of Hormuz. Natural gas, this chart has the line chart has the ETF to short natural gas, and the price curve with the candles, that's the futures market for natural gas. So as the futures market of natural gas starts to go down, cold ETF starts to go up. So you can see here that we're normally in August, there's a sell-off. And then in September or so, it starts to creep back up. And especially October, you might have a little bit of down, but normally August is going down, and then it wants to creep back up. So we should be trading a little bit lower in the rest of this month for natural gas. But the headwinds are the war in the Middle East and the consumption of power due to AI and the consumption of power due to El Nino with the use of air conditioners. Now, we're trading at approximately 2.671. I suspect that we get to 2.6, maybe even 2.5, but it is possible that we go back to 2.8 depending on the news. But once we get into the September month, we probably are going to be starting to see a little bit of a up down. You can see here it went up and then came back down, and then it really started marching up after September. So this month it should be down, and next month it should start be creeping up. Once it starts to creep up, you want to be exiting out of cold and going into boil. Right now I have a short on natural gas. Again, I think that the trading range for natural gas is anywhere from 2.5 to about 2.8, depending on what happens in the strait. TYD is a ETF that trades the belly of the curve for treasuries, 7 to 10-year treasury. It's a 3 times leverage ETF. The line chart here is the S&P 500, and the candle chart is longing the belly of the curve for the treasuries. You can see that the price, it's based on price, this ETF. So the price of the bonds, if they go up, then the yields go down, and the price of this ETF will go up. So it's relative to the price of the bonds. So price of bonds go up, typically textbook thought process is that bonds go up, equities go down. But that's not necessarily true, because the correlation here, you can see that there's been a very positive correlation between the price of the bond and the equity. Now, there has been times, especially last year, where it was more negatively correlated, which is textbook. But this year, it's not negatively correlated. It's more positively correlated. And because of that, we need to be mindful if we're using the treasury market as a hedge strategy against equities. So let's think about the dynamics here. We have the equity market going up, especially recently, and the bond market in relative terms, you can see here, you can see that roughly, the bond market was starting to go down. And then when there was this big, you can kind of see here, this is kind of right here, there was the yields on the bonds were going up, the price of the bond was going down. So this ETF was going down. And then all of a sudden, you had this really explosive increase in the S&P 500. And we also had lower yields, higher bond prices. Now, that did give a little bit of a relief rally for TYD, but I suspect that TYD will continue to go down. You see this overall trend is going down, and that yields will continue to go up. I suspect that if the Federal Reserve raises rates, we should see the yield curve shift upward, and it's very possible that the 10-year bond gets to 5%. Now, this chart goes into a little bit more detail about what I'm talking about here. The 30-year bond is approximately at 5.22. The 10-year bond yield is at 4.69. It's very possible that this 10-year yield may hit 5, and we may be above 5.5 for the 30-year. The Federal Reserve has been steady with their federal funds rate at approximately 3.63. And the spread between the 30 and the 10 has been in this range for quite a while for the last 3 months at approximately, if you average it out, probably 0.5. So a 0.5 or 50 basis yield spread. Right now, the yield spread is 0.53. So 53 basis points. But you can see that it's creeping up. So because it's creeping up, TYD is going to be going down. This is the VIX, and the VIX is a great way to understand the volatility of the broad market, the S&P 500. And these spikes are episodic, these big spikes. And we had usually these big spikes happen every month and a half, 2 month, maybe even 2.5 month time period. So we had a big spike, see, like here, well, because of what's going on with the Middle East, the episodes are happening a little bit more frequently. Like, let me give you an example of what a good point here is, the episodic. So this happened, we had a very high VIX level, and it started to come back down, and then we had another episode. So it was coming down and then another episode. So this happened in around April, right? And the next big episode happened in May. So April, almost June, almost June. So this happened about a month and a half or so, roughly. Here's another one so you have 1 month, August, and then another in September. So what's happening with the Trump administration is the episodes are happening more frequently. So here you have it August or October, the middle of October, and then all of a sudden it happens near the end of November. So it's a little bit like a month and a half. Here's another one where it's about a month or a little less. Here's a month. So if we use what's been going on, normally it's about 2.5. If everything's fine in the world, it's around 2.5, 2 months to 2.5 months of these spikes. So the point I'm making here is that we're low on the VIX. We're at 14.9. We recently, in late July, above 20. So we should see another spike at the right before the end of August, hitting close to 20. So I wouldn't be surprised, like around the third week of August, we hit another spike. So that means that we have we have a full week, maybe 2 full weeks within August before we see that spike. Now, when that's happening, assuming that everything is okay in the Middle East, that would mean that for the next 2 weeks, we should be ticking upward. So pay attention to this. I suspect that there's going to be another spike above 20 by the third week of August, near the third week of August, maybe the fourth week. But normally in a normal situation, you would see it like a 2 month delay. Like right here, you have June. In June, it was like the middle of June and went through July, everything was fine. And then right when August hit, it started up again. So the point here is that there's these episodes that are taking place. Next. SSG is an ETF to short semiconductors. This is something that you can only have a very short-term play, just a few days in. You cannot invest in this because of the volatility decay. And as the market continues to go up, especially because of this volatility going down, and it's probably not going to come back up until 2 weeks from now, you're going to see the S&P 500 go up past the 780. And because of that, what you're going to see here is that the semiconductors and the tech stocks are going to rally, and this ETF is going to go down. I suspect that we go maybe even test the 1091 level, maybe even break 10. And then once the volatility goes up, we're probably going to see tech sell off, and this will spike probably $2. So for the next 2 weeks, I wouldn't be surprised that we test the 10 level. And then once we see another tech sell-off, most likely in 2 weeks, we should see this start trading at 1250. Again, this is the short semiconductors. So that's the overall for the market to prep you for Monday's trading and the week's trading following. Now let me play the video that I wanted to play here. Okay, this is a video talking about why AI isn't actually boosting productivity. This is from Bloomberg.
Bloomberg Audio Studios. Podcasts, radio, news.
I'm Stephanie Flanders, head of government and economics at Bloomberg, and this is Trumponomics, the podcast that looks at everything in the economic world of Donald Trump. Today I wanted to dig into two seemingly conflicting stories about the global economy that are often embedded in the conversations on this show. I mean, one story that we hear often is that we live in an era of extraordinary innovation. New, more powerful AI models unveiled almost daily, and the US and China seemingly neck and neck in the race to dominate that transformative technology and reap the benefits. I mean, the challenge in that world is not that we have too little innovation, but too much, and how we're going to absorb it into the economy without blowing up everything that we hold dear. But another story, which we heard more often after the global financial crisis, but has definitely not gone away, is one of stagnation, of declining competition in large chunks of the economy, more and more meddling by governments. And of course, we've heard that particularly in Europe, but I think if you think about the rise of monopoly power, more and more tariffs getting in the way of global trade. I mean, we've certainly seen all of that in Trump's American economy, and not to mention the more direct involvement in the affairs of business that the president and his cabinet have engaged in. So I was interested to try and tease out some of these themes and try and get a sense of, are we in a very innovative era that means we're now about to have loads of growth, or actually potentially running the risk of something more negative? I wanted to discuss it with Carl Benedict Frey, who's the author of a book that came out last year, actually, How Progress Ends: Technology, Innovation, and the Fate of Nations. He's also an associate professor at Oxford University and often writes for the FT and other places. Carl, thank you very much for joining Trumponomics.
Good to be with you.
Before we get into this, I think it's probably helpful for people to understand what the argument of your book is, and specifically your thesis around how technological and economic progress happen and the patterns that countries have tended to go through.
So a key theme of the book is that institutions need to adjust as technology moves along, right? And so you can grow for a long period of time just by adopting and scaling technology invented elsewhere, right? And so the Soviet Union did that quite successfully over 4 decades. It took ample advantage of the Ford Motor Company's open door policy and transferred that knowledge to the Soviet Union, build a vehicles industry of its own. And in the age of mass production, the Soviet system actually worked fairly well because, when technology is mature, when production is fairly standardized, then you can hold factory managers accountable essentially just by benchmarking performance. But as the returns to the mass production system petered out globally in the 1970s and something new was needed for growth, that system did no longer work particularly well. Because when something is novel, when you're dealing with new technology, well, first of all, how do you benchmark performance? How do you hold factory managers accountable? And secondly, that new thing that was needed for further growth was the computer revolution, to which Soviet contributions were essentially none. Why is that? Well, a big reason is that the Soviet Union provided very little room for decentralized exploration. And so if you were an engineer in the Soviet Union, you could go to the Red Army and ask for funding. If they decline, well, you maybe had 2 or 3 other options. If they decline, then your idea would die with you. And that's quite different from the American system of more decentralized finance, where, Bessemer Venture famously declined to invest in Google back in 1999. They probably regret it today. But it also illustrates that Google was not a safe bet at the time. Alta Vista and Yahoo, they were dominating search. And so somebody, needed to invest to show that Google would actually catch on. And the fact that Bessemer didn't invest, though, didn't mean the end of Google because others stepped in. And so when you explore new technology, you need more people exploring different potential technological trajectories. And so that's the exploration phase. But once you've settled on a prototype, then you need to scale that. And that scaling in the Soviet Union did reasonably well. But when that runs into diminishing returns, you need to get onto the new cycle. And so you need to move from more centralized consolidation to more decentralized system again. And it's those shifts in institutions that make progress very hard to sustain.
If you just look at the title of your book first, anyone looking at that, particularly this year, How Progress Ends: Technology, Innovation, and the Fate of Nations, you'd have to think, well, however it ends, it doesn't seem to be ending at the moment. So what's your take on the world we're looking at now? Are we at the end of progress or just the beginning of amazing progress?
Well, the title of the book is not meant to suggesting that progress is inevitably about to end. It's more a reflection of the fact that progress is unnatural, right? If progress was inevitable, it would not have taken 200,000 years to have an industrial revolution. If progress was inevitable, most of the world would be rich and prosperous. If progress was inevitable, Britain, the country where I live, would not have suffered 2 decades of productivity stagnation. So progress is clearly not inevitable, and it's clearly not inevitable even despite the acceleration we've seen in innovation that you mentioned, right? So if you look at patenting, if you look at scientific publications, any measure of, inventive output, all those indicators are up. Yet, if you look at the economy, it's pointing in a very different direction, and even measures of research productivity and breakthrough innovation are down. So we're getting more in terms of scientific and inventive output, but it seems that we're getting less transformational output. And I think that's important to keep in mind when we're looking at the potential impact of the economy on artificial intelligence as well, because in many ways, the computer revolution was more transformative than the AI we have today, right? The computer and the internet connected the best scientists and inventors around the world. It streamlined the research process enormously. It gave us access to the world's stored knowledge, essentially in our pockets. And what do we get out of that? Basically, a decade-long productivity upsurge, mostly confined to the United States. Now, I do think that AI will show up in the productivity statistics eventually, but the question is by how much and for how long? And so, any productivity upsurge, you'll take it. But I think if you believe that we are entering a new renaissance for economic growth, you're likely to be mistaken, because AI is actually likely to give less of a productivity boost, even the computer revolution. And the reason is this: with AI, you still need verification. So AI automates, a lot of knowledge work, but in the end of that, you need to verify the outputs. And so it's the time saving minus the time for verification. The computer revolution was different, right? I could sit around and wait for hours, days, even weeks for new material to arrive for me to start my research. And the internet gave me access to that instantaneously. And so it automated downtime. AI is not automating that downtime, it's automating the production, and you still need verification as well.
I'm sure we'll get on to some of the implications of AI and also sort of the bearing of some of your research on that, because you sort of look back at thousands of years of what has produced innovation and then what's then translated that into growth. But just what you said about that sort of disconnect around, we've seen more invention at some level, lots more invention, lots more patenting and everything else. And yet seemingly at the micro level, at the real level of the economy, still quite a lot of low productivity and lack of translation of that technology into productivity. And thinking about that contrast between the US and China, there was a story that was told for many years, probably is still being told, about the innate advantages of the US in technological progress that was always around. China might be very good at copying things, but when it comes to actual innovation at the frontier, the US is always going to have an advantage over a sort of centralized system, China. There's quite a lot of support for that in your book. But I guess if you look all around, you would have to sort of say, well, maybe AI is going to be the exception, because they seem to be getting pretty close to the frontier on AI without having the kind of decentralized system that the US has.
Well, I think, first of all, there clearly is innovation in China, but China is also a country of 1.4 billion people. So it would be absolutely extraordinary if there was no innovation going on in China whatsoever. But in addition to that, though, China is not as centralized as is commonly believed. And so, unlike the Soviet Union, which also had a one-party system, where every industry was managed centrally from Moscow, whether it was railroads or steel, the Chinese economy is much more decentralized, and provinces and provincial governors and mayors have much greater autonomy than the Soviet counterparts would have had. And so what you have in China is a system where provincial governors are competing against each other based on often growth targets for promotion inside the one-party system. And so what that creates is essentially a tournament of political competition that is very hard to replicate anywhere else. And so where Europe does industrial policy, it often tends to be anti-competitive, right? Where German rearmament essentially means plowing funds into Rheinmetall. In China, on the other hand, industrial policy can often be pro-competitive because you have provinces seeding new firms that are competing against each other. And so I think that's often underappreciated part of the Chinese economy. That said, though, when you look at the firms which are leading in innovation in China, it's mostly startups. It's mostly privately funded firms. It's often foreign funded firms as well. And so in that sense, China is not that different from either Europe and the United States. What is different is that it doesn't have the rule of law. And so building political connections is more important in China because you need to have a seat of the table when priorities change, and priorities change from time to time. But perhaps somewhat paradoxically, what people believed in the 2000s, that China would become more like the United States, the opposite seems to be happening. And the United States today looks more like the political capitalism that you have in China. And, being on the right side of the current administration is important, which is probably one of the reasons that firms like OpenAI are saying that we are open to the government taking a 5% stake in the company, because if they are on your side, well, then you're on the right side of things from your perspective, at least.
That's a quite important theme in your book, which is that ultimately has undermined in the past a country's position at the sort of cutting edge of innovation, but also of growth. And you have the example of the UK after the Industrial Revolution, is that you have vested interests build up, which slowly kind of resist disruption and competition and new entrants to industries, which you then, gradually lose your innovative edge. You seem to see scope for that happening both in the US and in China at the moment, but I guess for very different reasons.
Yeah, and I think that's the natural order of things, right? So if you look historically, the leaders in bicycles didn't become leaders in automotive, although they tried, right? Legacy media companies did not lead the social media revolution. The legacy car companies did not lead in electric vehicles. The legacy retailers did not lead in e-commerce. And so it's a clear pattern that it's new firms that tend to develop new technology and new kinds of industries. And old industries have an incentive, or every incentive, to prevent that sort of competition. And so that's why we've seen the rise of killer acquisitions in the United States, for example, whereby incumbents buy up promising startups just to shut them down. That's why we see a revolving door between the U.S. Patent and Trademark Office and some incumbents, whereby patent examiners grant them low-quality patents and then take on jobs for these firms in return. And that's all of that is creating barriers to entry for new companies. And it helps explain why we see a decline in business dynamism, despite the fact that every technology from the personal computer, the internet, the cloud, and now AI will have made it much cheaper to set up a company and operate a firm. And yet we're seeing less entry. And so those barriers are clearly at work in the US, and they were at work in China as well. Although in China, you have the added component that the priorities of the CCP has changed over the past 15 years or so, from basically economic targets to targets that concern political means around self-sufficiency and national security, common prosperity, and so on. And what that means in the Chinese case is that creates a greater reliance on state-owned enterprises, because private firms are, for the most part, less keen on pursuing national non-economic objectives. And by any measure, state-owned enterprises in China have been less innovative and less productive. And that, I think, is unlikely to change.
One set of sort of arguments against or points against your thesis would be sort of in the realm of this time is different, or that AI might be a different kind of technology. You make the example of the bicycles to cars and other sort of classic technological shifts. And, you know, one argument that you could make just looking at the way AI has evolved over the last few years and even the last few months is it seems like scale matters more than anything else in the development of this technology. And whereas in the past we might have thought that it was going to be about different, you know, innovations around different ways of doing things, the big developments in AI seem to be coming just from throwing a lot of resource at LLMs, and you know and that the gains go to the country that has the most energy and the most chips. And at the moment, certainly the most energy is China, doesn't currently have the most chips, but doesn't seem to suggest that you need a lot of innovation or sort of new entrants, because actually the new entrants can't necessarily afford to put in all these enormous fixed costs. So what's the chance that this is just a different kind of technology? It's going to be innovating itself if it's given enough resource to do it.
So if what you said is correct, then clearly what I've written and said is wrong, right? And so I don't believe that that is the case, though. And so, you know, if the world was just a static distribution of events, you could probably, you know, brute force things, right? So more compute, more data would, you know, eventually get you there, right? But the world is not just a static distribution of events, it's changing all the time, right? And so, you know, my job today may be very different from my job tomorrow. Now, not all work is like that, and so there's a lot of things that's static, and you can automate that. But you know, a lot of things also require some degree of resilience, right? And so if you use AI to manage supply chains, that might, you know, work quite well, and then all of a sudden you have a pandemic and you don't know what on earth is going on. And we see this, you know, even in more confined spaces, right? So most people know of AlphaGo that beat Blizzardol 4-1 back in 2016. And so, you know, by that time already, AI had achieved superhuman performance in Go. Fewer people know that actually just a couple of years ago, human amateurs using standard computers beat the best available Go programs quite easily by exposing them to new positions, new concepts that they would not have encountered in training. And so that raises a sort of fundamental question of, you know, even in cases where we achieve superhuman performance, we cannot be sure if that's actually going to be true tomorrow when circumstances change. And so, you know, humans, we are capable of learning from just a few examples. We are very, very data efficient. And I think you will have to get to AI that is capable of that, and that will need some innovation. And so right now, we don't really know what the path forward in AI looks like. It may be that, you know, large language models is the future of AI. It may be that small language models. It might be world models. It might be something entirely different. And so I think what we need is greater data efficiency, and that's clearly not something we're going to get through just through scaling. AI is still, you know, waiting for what I call the separate condenser moment, because, you know, during this first industrial revolution, early on, steam engines, they were tremendously energy inefficient. They were basically just used to drain coal mines. They couldn't really be used for anything else. And it took the separate condenser to make them energy efficient, for them to be applied to transportation later on, railroads and steamships, etc. And I think AI is still waiting for that moment. And that's a question of, you know, further innovation, not just scaling.
It's also a very good documentary about the AlphaGo experience. And it was this sort of classic example that stayed in people's minds of like when the humans lost against this new technology. I was surprised to read in the book the idea that you actually had a fight back by people who were using techniques that AlphaGo had not been able to surmise from what it was learning from. And it's sort of interesting to me that people are determined to think that humans are going to lose this race rather than jumping on those kind of examples. So it seems like you would, again, I mentioned at the start, there's this kind of dizzying array of new models of AI, and then debates about how close the US is to China. When you're trying to think about AI's impact on the world and whether the US is ahead of China or behind China, is that even the right way to think about it when we look at the sheer power of these models as a gauge to that? Or should we be looking at other aspects of their economies?
So unless we get to a stage where some firm, some company gets onto a curve where it really, just pulls away from the rest, I don't think, whether the US or China or, OpenAI or Anthropic or Google is 3 months ahead or not. If one place really pulls ahead, that could have a meaningful impact, but it's not clear that that's going to be within the sort of space of large language models. It might be something else. And then there's the question of adoption. And obviously, in the end of the day, the use of a technology is what drives productivity. But there also the question is adoption for what? If people adopt it for email, it's not going to drive growth in any meaningful way, but it might look good in the sense that the adoption rate is high. But if people adopt it for scientific research in ways that develop new products and new technologies, that's obviously a different matter. And I think there, incentives matter a lot. And I think that has some bearing on why we're in this sort of global productivity stagnation since the computer revolution, really. So what you really see with the computer era is that inventors and scientists have taken on more projects since then. So when you get a new powerful productivity tool, right, you can do one of two things. You can either use it to drill deeper or dig deeper, or you can use it to drill more holes. And if you do more projects, just drill more holes, in the end of the day, your attention is going to be more thinly spread across multiple projects. And as a result of that, you're actually less likely to make a breakthrough at any given time. We see that in the data. AI seems to have had the same effect. AI means that we can do more things, but people seem to be using it to do more things rather than digging deeper. And so in academia, the incentive is publish or perish. And so we shouldn't be surprised if people use it to produce more output rather than, spending the next 10 years maybe producing nothing, but coming out with a real breakthrough by the end of that period.
Finishing this line of thought, if you're a country, as most countries are, that are not home to companies that are absolutely at the forefront of producing this technology, probably your government is saying adoption is key. Certainly we hear this in UK, we hear this in Europe. And to your point, the most important thing is going to be the way we adopt this technology, not whether we happen to own this or that piece of it. What are the lessons from your analysis for governments that want to try and make the most of these technological advances and translate them into growth?
So I think if you're behind the frontier, which is inevitably true for most places, and that was true during the second industrial revolution, the computer revolution as well, the best thing you can do is trying to adopt technology invented elsewhere. And then the question is obviously how easy is that? And so during the post-war period, the United States had an explicit policy through Marshall Aid where it shared technology with its allies. And that contributed, I think, to a meaningful degree to the post-war miracle in Europe, also in Japan and Korea. Similarly, with the computer revolution, buying used technology has been fairly straightforward for most places. And so, the reason that the entire world isn't rich and isn't, at the frontier in computers is not that computer technology is not unavailable to them, but that there are, some institutional or perhaps cultural constraints that prevent adoption, or at least sort of prevents the creation of domestic firms and domestic industries around these new technologies. AI is not really different from that, but it might become different in the sense that there are clear national security concerns around that. And so you saw that recently with the Trump administration imposing restrictions on foreign use of Anthropic's latest model. We can expect to see similar things happening going forward, perhaps at greater scale. And that, obviously means that you cannot really be dependent on the technology leader. You have to try to grow some domestic capacity. With AI, with large language models, the easiest way of doing that is through open source or open weights. And, that's how China has closed the gap. It really embraced an open weights ecosystem, in large part because of export controls on ships, which essentially forced it to go there. And so I think for many countries, they will be probably pivoting either towards Chinese or European technology if they feel that America is an unreliable trading partner in technology, or they may try to build their own domestic open weights ecosystem. Although that is going to be, I think, a harder approach for most places.
Carl Benedict Bray, thank you so much.
Been a pleasure, thank you.
Well, that's the end of this broadcast. Please help support the work that I do by making sure that you subscribe to all the channels: YouTube, Brighteon, Bitchute, and Rumble. You can also follow me on X, GETTR, TikTok, Substack, and be a paid member to my Patreon channel. Again, you can also donate on my website, the-studio-reykjavik.com. You can donate through Stripe, PayPal, or buy me a coffee. All these videos are for free. Please help support the work that I do and get the great supplements that I offer. These are supplements that will help to slow down the aging process and get you healthy. Thank you for listening and have a nice day.